this week I'm going to look at our last key topic in management accounting, and that's about budgeting and budgetary control. Now, a budget is simply a short-term financial plan, and it's normally prepared for one financial year. So it's prepared in advance of the financial year, showing what the planned levels of sales revenue and costs and cash flows are going to be over the next financial year. And the budget is the way in which a business implements its longer term strategy. So it's the short term implementation, an operating plan by which a business will achieve its higher level strategic objectives. So businesses may well have quite a lot of budgets. They'll have budgets for revenue and budgets for costs, different types of expenses, and they'll have budgets for revenue from different products, from different sales teams. Budgets can be very, very detailed. But basically, the budgets which most businesses prepare would be a cash budget, a profit budget showing the income and the expenses, and less popular would be a budgeted balance sheet. So budgets are short-term financial plans, and they're used to set targets for management, to make sure that a business is doing the best it can to try to meet its longer-term strategic objectives. Now, one thing that we use budgets for is control, and we talk about budgetary control. And budgetary control is connected to management by exception. Management by exception. Management by exception simply means that if our costs and our revenues and our cash flows are going in accordance with our plan, they're kind of on budget, then we don't have to worry about those. But if we have some revenues and some cash flows and some costs and expenses which are not going according to our plan, our budget, then we need to look at those. So we manage by exception. We ignore the things which are going according to our plan, our budget, and we investigate and find out more about our costs and our revenues and our cash flows, which are not going according to our plan. So budgetary control involves comparing the actual performance achieved by a business, whether that's costs or revenues or cash flows, comparing the actual performance with the plan. So budgetary control involves analysis of variances. Now, variances are simply the differences between the plan that we put in our budget and what we actually achieve. And so we do a comparison of budget figures against what we actually achieve. And any differences between our budget and what we actually achieve, those differences are known as variances. Now, where a variance is good news, so for example our actual revenue is higher than we expected in our budget, we would have a favourable variance. But where a variance is bad news, so for example, if our actual revenue was below what we expected in our budget, then that would be called an adverse variance. So variances are either favourable or adverse. Now, how do you know if a variance is favourable or adverse? Well, what you're looking for when you're analysing variances is simply the difference between the budgeted figure and the actual figure. So, for example, we might have budgeted to have £1 million of sales revenue. What we actually achieved was maybe only £850,000. So our sales revenue, our actual sales revenue, was £150,000 below our budgeted sales revenue. So we have a variance, the difference between these two figures. Now you don't need to worry about whether that difference is positive or negative. Is it 1 million minus 850,000, or is it 850,000 minus 1 million? You just need to know what the difference between those two numbers is. And in this case, this would be an adverse variance because we achieved a level of sales which was below what we budgeted, and that's bad news. So we would say we have 150,000 adverse variance. So when you're trying to work out your variances, don't get tied up about whether they're positive or negative. You have to think about them in terms of whether they're adverse or favourable. Now, favourable variances, when things are going particularly well or better than we budgeted, that would be where our sales budget, our sales actual figures were greater than the budget figure, or where our costs actual are less than the budget figure. So where we've got more sales revenue than we expected, that's favourable. Where we've got costs that are lower than expected, then that's also favourable. So our adverse variances are the opposite way round. If our actual sales are below our budget, that's an adverse variance. That's not good news. And if our costs are greater than our budget, our actual costs are greater than budget, then that's also bad news. We're spending too much. Our costs aren't under control. So those are the very simple rules for working out whether you have a variance, you're just comparing the budget with the actual, and whether your variance is favourable or adverse. And businesses in the real world are doing this every month. They're producing their actual figures each month as part of their management accounting, and they're comparing them with their budget figures for that month. And where there are variances, and where those variances are significant, so not just a few pounds here and there, but where the variances are significant, then we need to follow up, we need to investigate those variances. And where our variances are favourable, we want to see if we can carry on getting those favourable variances in the future. But where the variances are adverse, we want to take corrective action. We want to cut those costs down or boost our sales revenue back to what we expected it to be. And that's why we can control the business through budgeting and analysis of variances. That's why we call it budgetary control, because we're keeping our business on track by looking at things which are going wrong, the adverse variances, and taking corrective action, and looking at things that are going really well and looking to see if we can replicate those in the future. So that's just the key points about analysis of variances, and you may well be doing a question on this in the exam. Thank you.